Before you click away, hear this. The United States national debt right now, at the end of December 2025, sits at a staggering $38 trillion. Not projected, not a future estimate. Actual recorded debt on the books today. That number isn't just abstract government accounting. It touches every bank account, every mortgage, every bond, and every retirement plan in the country. But most people have no idea what it really means. While you were scrolling social media, binge-watching shows, or checking your portfolio one more time, the largest financial institutions on Earth have quietly done something they haven't done in 75 years. They started moving capital out of dollar-denominated assets. Not in headlines, not in press releases, not with fanfare, but systematically and invisibly. And this isn't speculation or conspiracy theory. This is documented. This is public. Treasury data, international filings, and capital flow records, you can verify yourself, all point to the same truth. By the end of this video, you will understand what is happening, why it is happening, and what comes next. Because this is not random chaos. This is a pattern, a mathematical pattern, with distinct stages that have played out 3 times before in global history. Same structure, same progression, same devastating finish. The only question left is this: will you see it coming, or will you be shocked when it's already too late? The total global debt has just hit $251 trillion, according to the latest IMF data. That's roughly 235% of global GDP, the highest ratio recorded in peacetime history. And the United States stands at the center of it all. In January 2025, the U.S. national debt was $36.1 trillion. By December, it had leapt to $38.4 trillion, a $2.3 trillion increase in just 11 months. That rate of borrowing is unprecedented. But here's the part almost nobody is talking about. This exact same scenario has happened before. And every single time, the nation holding the dominant reserve currency collapsed within 18 to 36 months once capital began fleeing. Not similar collapses. Identical cycles, same stages, same outcome. This is not theory. This is history. Let me show you how it works. Every major economic collapse in the last 5 centuries, from Spain in the 1500s to the Dutch Republic in the 1600s to Great Britain in the 20th century, followed the same 4-stage cycle. Stage 1, the ascent. This is the rise to global dominance. A nation becomes the center of world finance. Capital pours in from everywhere. Its currency becomes the standard for international trade, the go-to for commerce, for reserves, for global contracts. Confidence is absolute. Markets boom. Innovation explodes. The future looks limitless. This phase typically lasts 50 to 80 years. Stage 2, overextension. Success breeds excess. The government expands spending beyond its means. Militaries grow, bureaucracies balloon, foreign entanglements mount. Domestic programs get expensive. People borrow, believing the good times will never end. Debt grows faster than the economy. And central banks print money to keep asset prices rising. Real estate booms. Stocks hit record valuations. Everyone feels wealthy because prices everywhere keep going up. This stage can persist for 20 to 40 years, until the cracks start to show. Stage 3. The silent exodus. This is the critical phase that most people never see coming. The public doesn't see it. Politicians don't see it. Only those who understand balance sheets, capital flows, and global finance notice first. The smart money begins to leave. Major institutions quietly reduce exposure. Sovereign wealth funds slowly divest. Wealthy families move assets offshore. Foreign holders start selling reserve holdings. There are no press releases, no breaking news alerts, just the systematic reallocation of capital into safer assets and jurisdictions. This phase typically lasts 18 to 36 months. Stage 4, collapse. After the silent exodus reaches a tipping point, the currency's reserve status erodes. Foreign central banks dump holdings. Inflation explodes, interest rates spike, asset prices implode, banks fail, pension funds evaporate, middle classes are wiped out, political instability follows, societies fracture. Then the inevitable question echoes everywhere. How did we not see this coming? The answer is simple. The pattern was always there. Let's look at 3 historical examples. 3 global superpowers, 3 reserve currencies, the same cycle playing out across nations and centuries. Example 1. Spain, the 1500s, superpower. In the early 1500s, Spain was the dominant force on Earth. The Spanish real was the global reserve currency. Spanish galleons flooded home with gold and silver from the Americas, more treasure than had ever been seen in human history. If you wanted to trade internationally, you needed reals. Madrid was the financial capital of the known world. King Philip II controlled half of Europe. The Spanish Armada ruled the seas. Wealth poured in from colonies across 3 continents, but Spain squandered it. War after war defined their foreign policy. France, England, the Ottomans, the Dutch, all fought simultaneously. Royal palaces drained treasuries. Bureaucratic spending exploded, and the Inquisition burned gold along with heretics. By 1550, Spanish government spending ran at 300% of revenue, meaning they borrowed 3 times what they collected in taxes. Yet, as long as gold kept flowing from the New World, nobody worried. Asset prices continued rising. Spaniards felt rich. The empire seemed eternal. But then, subtle changes began. In 1555, major Spanish banking families began moving assets to Genoa. The powerful Fugger family, Spain's biggest creditors, started demanding repayment in real gold instead of paper promises. They were signaling they no longer trusted Spain's fiscal health. In 1556, wealthy merchants opened operations in Amsterdam. Gradually, trade routes shifted, warehouses relocated, and commerce flowed elsewhere. Why? Because these insiders read the financial statements. They saw that Spain was effectively bankrupt. The government was paying interest rates as high as 40%, a sign not of strength, but desperation bleeding through official documents. Then came the collapse. In 1557, Spain defaulted for the first time. Credit markets froze. Spanish bonds became worthless overnight. The government seized private gold shipments to pay soldiers. Chaos rippled through the system. They defaulted again in 1560, 1575, 1596, 1597. 4 defaults in 40 years. The Spanish real lost all credibility. Inflation destroyed the middle class. The mighty empire shrank to a shadow of its former self by 1600. And where did the capital go? North to the Dutch Republic. Example 2. The Dutch Republic, the 1600s financial powerhouse. By the early 1600s, Amsterdam had become the richest city in the world, more powerful financially than any other. The Dutch East India Company was valued at what would be over $8 trillion in today's money, dwarfing even the biggest tech giants. Dutch banks financed global trade. The Amsterdam Stock Exchange became the first in history. The guilder was the global reserve currency. If you were a merchant settling a deal anywhere on the planet, you used guilders. Capital flowed into Amsterdam from Asia, Africa, the Americas, and across Europe. It was, in essence, the world's financial capital. The Manhattan, the London, the Wall Street of its day. Then came war. 3 Anglo-Dutch wars between 1652 and 1674, repeated engagements with France and Spain, and an escalating military budget coincided with an unprecedented rise in government debt. Dutch debt increased from 4 million guilders in 1650 to 80 million by 1690, a 20-fold increase in just 40 years. To pay for war, Amsterdam began printing money. Sound familiar? Meanwhile, a speculative fever gripped the market. Tulip mania saw prices of rare bulbs soar until a single bulb could cost more than a house. Asset prices detached entirely from reality. Everyone felt wealthy. But under the surface, risk was accumulating. The Bank of Amsterdam, long seen as a fortress of financial safety, had begun lending depositor funds to governments, effectively fractional reserve banking long before it had a name, a Ponzi scheme dressed in legitimacy. By 1690, the insiders smelled trouble. Major banking families moved headquarters to London. Portuguese traders opened offices in England. German financiers systematically pulled capital back home. Quietly, over years, the smart money exited. By 1795, revolutionary French armies invaded. The Dutch Republic collapsed. The guilder lost its value. Riots broke out. Depositors lost everything. Capital flowed to London, the city that became the next financial center of the world. Example 3. The British Empire, the 1700s to 1900s. For over 2 centuries, the British pound sterling reigned supreme as the global reserve currency. At its zenith, Britain controlled a quarter of the world's landmass and population. London was the financial capital of the globe, and where anyone seeking capital for infrastructure, trade, or development turned. More than 60% of international trade was settled in sterling. The gold standard was built around the pound. British banks financed railroads in America, colonies in Africa, trade routes in Asia. The world ran on British money. But empires fight wars, and wars are expensive. World War I cost Britain over £44 billion, more than $600 billion in today's terms. Debt skyrocketed from 30% of GDP to 130%. Remember that number, 130%, because the US is topping similar levels today. Attempts to defend the gold standard failed in 1931. After World War II, Britain was technically victorious, but financially shattered. It survived only on loans from the United States. This is the classic overextension stage. By 1949, capital began flowing out. British companies expanded into America instead of investing domestically. Wealthy families moved assets to safe havens like Switzerland and Canada. Scientists, academics, entrepreneurs, and innovators all sought opportunity abroad. By 1960, foreign investment in Britain had plummeted by over 60% from pre-war levels. The tide had turned. Then came the collapse. In 1967, sterling was devalued by over 14% overnight. The government had run out of foreign currency reserves defending the exchange rate. By 1976, Britain had to beg the IMF for a bailout. The pound lost its reserve status. Global trade shifted to the US dollar. The British century was over. This cycle repeated itself with eerie precision. Now let's bring this back to today. In 1944, at the Bretton Woods Conference, the United States emerged as the dominant global economic power. The dollar became the world's reserve currency, backed by gold at $35 per ounce. Capital flowed into the U.S. as Europe and Asia lay in ruins after World War II. American markets became the deepest and most liquid on Earth. This was stage one. But in 1971, President Nixon severed the dollar's gold backing. The dollar became pure fiat currency, not anchored to gold or commodities, but backed solely by faith in the U.S. government. Once you remove limits, spending explodes. In 1980, U.S. national debt was $900 billion. By 1990, $3 trillion. By 2000, $5.6 trillion. By 2008, $10 trillion. By 2020, $27 trillion. And now in 2025, $38.4 trillion. That's more than a 400% increase in 45 years. But that's just the government's side of the ledger. Corporate debt sits at $13.5 trillion. Household debt at $18 trillion. Student loans nearly $1.8 trillion. Credit card debt $1.1 trillion. Auto loans $1.6 trillion. And that doesn't even include medical debt, which is hundreds of billions more. Put it all together, public, private, household, and total U.S. debt tops $100 trillion. That equals roughly 370% of GDP. For perspective, Spain defaulted at 200% of GDP. The Dutch Republic collapsed at 250%. Britain lost reserve status at 130%. Yet the United States today stands at 370% and climbing. So how do you pay interest on that mountain of debt? In 2025, the U.S. government is paying over $1 trillion per year in interest alone. More than defense spending, more than Medicare, more than whole government departments combined, just to service the debt, not reduce it. Where does that money come from? You guessed it, printing more money. The M2 money supply, the broadest measure of money in circulation, exploded from $15.5 trillion in 2020 to $21 trillion by 2022. Nearly a 40% increase in just over 2 years. The largest monetary expansion in U.S. history. What does that create? Inflation. Asset bubbles, wealth inequality, markets that keep rising despite fundamentals weakening. Everything from housing to stocks to bonds trades at inflated prices. This is textbook stage 2, overextension. But now, stage 3 is unfolding right before our eyes. Let's look at the numbers. In 2013, China held over $1 trillion in U.S. treasuries. Today, that figure sits around $760 billion, meaning China has sold over $300 billion in U.S. government debt over the past decade, according to documented public records. Japan, the largest foreign holder of U.S. treasuries, has reduced its holdings by $220 billion since 2022. Saudi Arabia is selling. Belgium is selling. Switzerland is selling. France is reducing exposure. Even the Federal Reserve itself is shrinking its balance sheet, letting bonds mature without replacing them, a process known as quantitative tightening, draining liquidity from the system at a time when others are fleeing. So who is buying U.S. debt now? Mostly the U.S. government itself and government pension funds, in effect, recycling money back into its own debt. Not strength, desperation. Major financial institutions are shifting their portfolios too. BlackRock, the world's largest asset manager with over $10 trillion under management, has systematically reduced exposure to U.S. treasuries and increased positions in emerging markets, European infrastructure, Asian real estate, gold, and commodities. JP Morgan has restructured institutional allocations. Goldman Sachs has reduced U.S. equity recommendations. Morgan Stanley has increased international weightings. Bridgewater Associates has been publicly warning about dollar devaluation for years and positioning accordingly. The smart money is moving first, just like it did in Spain, Amsterdam, and London. Stage 3, verified. And now, once capital leaves the core, the only phase left is stage 4. What does collapse actually look like? If history repeats, the dollar will gradually lose reserve status. Not overnight, not with a single headline, but steadily as nations diversify their trade in other currencies. It is already happening. China and Brazil are settling trade in yuan. India and Russia are using rupees for bilateral agreements. BRICS nations are building alternative payment systems. Over 40% of global GDP now exists in economic blocs deliberately reducing dollar reliance. And the petrodollar, the arrangement that has underpinned U.S. currency dominance since the 1970s, is fracturing. It wasn't a formal written treaty, but rather an informal understanding between the United States and Saudi Arabia beginning in 1974. That arrangement has now quietly evolved. Saudi Arabia and other oil producers have openly discussed accepting currencies other than dollars for oil. When global demand for dollars drops, what happens? Dollars held overseas by foreign central banks come rushing back home. They flood the U.S. economy. That is when inflation goes vertical. The Federal Reserve faces a brutal choice: raise interest rates sharply to crush inflation, which would make the $38 trillion debt impossible to service and crash the economy, or continue printing more money, which destroys the currency through hyperinflation. Either outcome leads to collapse, just in different forms. Asset prices implode because liquidity disappears. Stocks, bonds, real estate, everything deflates simultaneously. Banks fail. Pension funds go insolvent. Insurance companies collapse. The middle class, which holds most of its wealth in dollar-denominated assets, is wiped out. Savings evaporate. Retirement accounts vanish. Home equity disappears. This isn't rhetorical alarmism. This is the pattern. And now, for the first time in decades, all the major indicators are screaming. Stage 3 is well underway. So what does this mean for you? Not tomorrow, not next year, right now. First, if most of your wealth is in dollar-denominated assets, you are exposed. Not maybe, you are. Diversification is no longer optional, it is survival. Consider assets that hold value during currency debasement. Gold, which has preserved wealth for thousands of years. Silver, commodities and real assets that cannot be conjured into existence by central banks. Second, geographic diversification matters. If institutions are relocating capital internationally, you should consider international exposure too. Not all your assets, but some. Stable currencies like the Swiss franc, Singapore dollar, and Norwegian krone deserve attention. Third, understand the timeline. Stage 3, the exodus, has historically lasted 18 to 36 months. Based on observed foreign selling patterns, we are roughly 12 to 15 months into that phase. That means you have time, but not years, months. Use it wisely. Fourth, increase liquidity. Cash loses value to inflation, yes, but liquidity gives you options. In a crisis, liquidity allows you to buy assets at crash prices, make strategic moves, and stay nimble. Illiquid assets trap you when mobility matters most. Fifth, reduce debt. Rising interest rates and structural inflation make high leverage financially dangerous. Every point rates rise makes servicing your debt more expensive. If you carry large liabilities, reduce them now. Sixth, invest in skills and relationships. Human capital, expertise that creates value and knowledge that solves problems, is the asset that survives every collapse. These are not printed away by governments or erased by currency devaluation. Seventh, stay informed. Those who survive transitions are not always those with the most money. They are those with the best information and the courage to act on it. In the next video, we will break down 3 specific asset classes that historically outperformed during currency collapses, which preserved wealth, which profited, and which were utterly destroyed. We will look at how gold behaved during Britain's collapse, how real estate fared during Spain's defaults, and how stocks performed through every major currency crisis in recorded history. Because this pattern doesn't care if you believe in it or not. It doesn't need your acceptance. It doesn't wait for consensus. It unfolds with the precision of mathematics, like gravity itself. Right now, we are in stage 3, the silent exodus, the phase where capital quietly leaves. And only those paying attention notice before it's too late. The only unanswered question is this: will you position yourself correctly when stage 4 arrives? Or will you be asking, like millions before you, how you missed all the signs right in front of you? The information is here. The pattern is clear. The data is verifiable. The choice is yours. Drop a comment below. Tell me what you think, how you're preparing, where you disagree, and what questions you have. I read every single one. Subscribe and hit the bell, because the next video will break down the best strategies for navigating this coming phase. Thanks for watching. And remember this: the people who survive these transitions are not always the ones with the most money. They are the ones with the best information and the courage to act on it.